Hey everyone, welcome back to Corporate Decoder. Today, DLH Holdings Corporation just filed their quarterly report, and I am seeing some major shifts that could signal trouble ahead. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company's revenue has taken a huge dive, and it looks like they are struggling to adapt to new contracts with smaller businesses. Alright, let's dive into what DLH Holdings Corp has reported for the quarter ending the 30th of June 2026. This is their standard quarterly update, and it gives us a snapshot of how the company is doing financially. Looking at the big picture, the company's revenue for the 3 months ending the 30th of June 2026 was about $44.2 million. Now, that sounds like a lot, but compare that to the same period last year, 2025, when their revenue was over $83 million. That is a drop of almost $40 million, which is a huge hit over the first 9 months of 2026. Revenue dropped from over $263 million last year to around $172 million this year. This is a very significant decrease and really shows the company is facing some serious headwinds. The report says this big drop in revenue is mainly because certain contracts have shifted from DLH being the main contractor to smaller businesses taking over. This means DLH is either losing out on these contracts or working as a subcontractor, which typically means less revenue. To go along with the lower revenue, their contract costs also dropped significantly, by about $30.8 million for the quarter. This makes sense when you have less work to do. Your direct costs go down. Over 9 months, contract costs fell by over $71 million. Now, here is where things get a bit more concerning. Even though revenue is way down, their general and administrative costs, which are things like salaries for people not directly working on projects, haven't dropped as much. For the quarter, these costs only decreased by about $300,000. As a percentage of revenue, these costs have ballooned from 9.2% last year to 16.6% this year for the quarter. This means a much larger chunk of their shrinking income is being spent on overhead. Over 9 months, these costs fell by $1.8 million, but as a percentage of revenue, they increased from 9.1% to 12.8%. This indicates a real problem with managing their overhead in relation to their actual business volume. All of this is leading to a loss from operations. For the 3 months ending the 30th of June 2026, they reported a loss of almost $4 million compared to a profit of about $3.7 million last year. For the first 9 months, the loss is even bigger, at nearly $2.6 million compared to a profit of over $14 million last year. This is a massive swing from profitability to a loss. And when you look at the bottom line, the net loss for the quarter is a staggering $16.8 million. Last year, they had a small profit of $289,000. For the 9 months, the net loss is over $20 million, a huge flip from a net income of over $2 million last year. This really highlights the financial strain the company is under. This translates to a loss of $1.16 per S-hair for the quarter, down from a tiny profit of $0.02 last year. For the 9 months, it is a loss of $1.42 per S-hair compared to a gain of $0.16 last year. Investors are definitely feeling the pinch here. Let's quickly look at the balance sheet to see their financial health. As of the 30th of June 2026, their cash balance is very low, only about $235,000. Their accounts receivable, which is money owed to them by customers, has also decreased significantly from about $38 million last September to around $24 million. On the liability side, they have a substantial amount of long-term debt, over $104 million. This is a lot of money to owe, especially with their current revenue problems. And their retained earnings, which is basically the company's accumulated profits over time, has turned into a deficit of almost $9.5 million. This means they have lost more money than they have ever made. Interestingly, the company recorded a significant provision for income taxes, nearly $10 million for the quarter. This is partly due to establishing a valuation allowance against their deferred tax assets because they don't expect to realize them given their losses. This is a non-cash item, but it impacts their reported profit. Their debt situation is worth a closer look. They have a secured term loan of over $115 million. While they are making payments, the total debt burden is considerable. The interest rate on this loan is tied to SOFR, the secured overnight financing rate, plus a spread, with SOFR around 3.7%. Their rate was about 7.8% as of the 30th of June 2026. This means a 1% increase in SOFR could cost them over $1 million more in interest per year. The company is still expensing stock-based compensation, which is a common practice. For the quarter, it was about $219,000. This relates to things like stock options and restricted stock units for employees and directors. There is still over $3.5 million in unrecognized stock based compensation expense that will be recognized over the next few years. DLH is also reporting some non-GAAP measures like EBITDA and adjusted EBITDA. For the 9 months, their EBITDA was about $10 million, and adjusted EBITDA was about $15.2 million. While these numbers exclude certain expenses to show operational performance, the significant drop from last year's $27.4 million in both categories is still a clear sign of the business decline. Looking at their customers, the Department of Health and Human Services is their biggest client, making up over 57% of revenue for the 9 months of 2026. However, this is down from almost 50% last year, and the overall revenue from them has also declined. The Department of Veterans Affairs was their second largest customer, but has also seen a significant drop in revenue contribution. The company is heavily reliant on these few large government agencies. The loss of any one of these major contracts could have a severe impact on their business. The report mentions that the VA has been shifting contracts to small businesses, which is likely a major reason for DLH's revenue decline, especially in the pharmacy and logistics services. Their backlog, which is the estimated future revenue from existing contracts, has decreased from over $514 million at September 2025 to about $408 million in June 2026. While this still represents a lot of potential work, the decrease suggests fewer new contracts or reduced scope in existing ones. The management's discussion also points to challenges. They talk about a difficult federal budget outlook for fiscal year 2027, with potential cuts in civilian agency spending. They also mention that government procurement processes like bid protests and small business set-asides can limit their ability to win prime contractor positions. A significant point is their goodwill. The company performed an impairment test and concluded their goodwill was not impaired. However, they note that a decline in share price was a trigger for this assessment, and they used multiple methods including market multiples and discounted cash flows to determine their fair value. While they passed the test this time, the fact that their market cap fell significantly enough to trigger this review is concerning. Liquidity is a major concern. Their cash on hand is extremely low, at only about $235,000. They do have some borrowing capacity left on their credit line, but with declining revenue and significant debt, managing their cash flow will be critical. Overall, DLH Holdings Corp is going through a tough period. The revenue decline driven by contract shifts to smaller businesses, coupled with persistently high overhead costs, has led to significant losses. Their heavy reliance on a few government agencies combined with a substantial debt load creates a risky financial situation. The significant decrease in revenue and the shift to a net loss position are the most alarming trends here. The company is clearly in a period of transition, and it remains to be seen if they can successfully navigate these challenges and return to profitability. What is my take? The company's strategy to win new business in a competitive market seems to be hitting roadblocks, and the shifting government contracting towards small businesses is directly impacting their top line. The significant increase in Jatimi AA as a percentage of revenue is a red flag, suggesting they are not scaling their costs down fast enough to match their shrinking revenue. My biggest concern is their ability to manage their debt obligations given the current financial performance and the very low cash balance. What I'm actually looking for is a clear strategy to either regain market share or significantly cut costs to match their current revenue levels. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.